You're watching Business Incorporated live from Channels HQ. Coming up, Fitch Ratings affirms South Africa's credit rating as junk status with a stable outlook. And the Bank of Ghana has pegged the rate of depreciation of the cedi to the dollar at 54.2% in almost 11 months of 2022. Plus, oil futures fall more than $2 a barrel today, with WTI hitting an 11-month low as protests in top importer China raises demand concerns. Great to have you join us on the program. I'm Ladi Williams. Let's kick off now with the markets. Let's look at how your money's performing at intraday, starting with Africa, where it's negative sentiment right now. We see South Africa there's down about 0.16%. Egypt also down 0.39%. And in Kenya, we see Kenya market closed negative. That was on Monday, actually on Friday, continuing that bearish momentum we've seen in the Kenya bourse. Now, let's take a peep into the NGX at intraday. Joining us now is Damilola Olukmono, analyst and banking and financial markets, Chapel Hill Denham. Great to have you on the show.
Yeah, thank you for having me, Ladi.
Yeah, so what's the sentiment in the market right now?
Yeah, the sentiment is a bit bearish, coming on the back of the 6.88% gain, we saw week on week last week. On the back of those gains, we saw, profit takers, are all out to take advantage of the elevated prices in the market and just lock in some gains, especially given the fact that, the macroeconomic climate is not favorable at the moment. And we are just seeing pockets of profit taking, here and there.
And our very own Aniete did predict that he was actually going to see profit taking in the market. He said that early in the morning. I guess we're seeing that already play out. But what stocks are moving the market right now?
Yeah, we are seeing profit taking, on the banking front. Last week, we saw the likes of GTCO, Access Bank, Semi Bank, all came last week. And, resumption of market today, just see sellers on that front. And it's a bit surprising, because if you look at the dividend yield potential of some of these banks, they're elevated at the moment and they're very attractive. So one would expect that, coming to the market today, we would see that sustained rally. But then we haven't seen that come on board as the profit takers, have pretty much come back. We've also seen some pockets of losses as well in the industrial sector, where we've seen Bois Cement, also lose steam, as that market opening today. But by and large, bulk of the losses have stemmed from the banking and the industrial sector.
All right, what are you seeing for the close of trade today?
So for the close of trade, we think it would be bearish as a close of market today. As at my last check, activities were not very strong. Think the depression in share prices, we've seen the banking counters and also some of the industrial tickers, might just push market to a negative territory. Albeit we think yesterday performance, will still remain at the double-digit region. We don't see markets plunging to the extent that we erode, some of the significant gains we saw last week. We expect market to close bearish today, and possibly we'll see some buy interest, coming tomorrow as well.
What's your outlook for the week?
Yeah, my outlook for the week is, given where the NPR rate is, we think going into this week we might see upward pricing in yields in the market, which is somewhat negative for equity valuation. So the market might trade sideways today as we'll see a shift in investor appetite and sentiment, towards the fixed income market. Albeit, we think the market might stay flattish, on the back of my sideways expectation for the market this week. However, from a dividend yield perspective, we still continue to see scope for further buying interest in some banking names and also some industrial names like WAPCO as well, barely double-digit dividend yield opportunities.
All right, thank you so much. That was Damilola Opono, the analyst, banking and financial markets at Chapel Hill, Denham. Thank you so much for that intraday analysis.
Yeah, thank you for having me, lad.
All right, now let's take a look at what's happening in the Middle East there. We see it's also mostly red there. Abu Dhabi down 0.69%, and the Dubai index, we also see it's down 0.81%. Other parts we track in the Middle East there, talking about Saudi Arabia, that's the only gainer we're seeing at intraday, up 0.28%, and we see Qatar there down almost 1%. All right, let's flip over now to Europe. Well, talking about the ongoing debate over revamping Germany's citizenship process, German Chancellor Olaf Scholz called for reforms to the country's citizenship rules in a video message that was over the weekend amid a pushback from the country's conservators. Let's get the details now from Janelle Dumoulin right there in Berlin. So, Janelle, what was Scholz's message?
Well, hello from Berlin. And first off, it's important to note, just as a bit of background, that the coalition government has made easing citizenship rules a priority. So that was even before this government was elected. We're talking about the center-left Social Democrats, that is Olaf Scholz's party, the environmentalist Green Party, and the business-friendly Free Democrats. And this is all happening against the backdrop of Germany's demographic challenges. So Europe's biggest economy has an aging population, and it needs migration to be able to overcome the gaps in its labor force. So basically, German Chancellor Scholz released a video message over the weekend calling Germany a country of hope. And he emphasized the role immigrants played in developing the country, especially those who came here as guest workers many decades ago and built families and lives. So on this Monday, Scholz is also speaking on the government's ideas for integration. At the same time, the country's Interior Ministry is expecting to unveil its draft legislation on the citizenship process. And this is something that has been much awaited here in Germany and is being very closely looked at.
Yeah, but what changes are being proposed at this time?
According to what has so far been reported here, especially in the German press, the draft law would allow foreigners living in Germany to apply for citizenship after 5 years instead of 8 years, as it currently stands. Much less clear is what is meant by, quote, special integration measures, which would make naturalization an option for immigrants here just after 3 years of living in Germany. Now, additionally, the draft law could make the holding of dual citizenship easier. Dual citizenship is currently allowed for people holding Swiss or other European Union citizenships. Everyone else has to give up whatever they have in favor of the German one, should they want it. Now, the Interior Minister has said that shortening the number of years to qualify for citizenship is an incentive for immigrants to integrate here in German society. But there's been pushback, especially from the more right-wing parties here in Germany, who argue that these measures would end up making the German passport weaker and that it would somehow generate more illegal immigration and not less.
All right, so it's the start of the week. What are we expecting in Europe and Germany?
Well, like everyone else at the start of this markets week, European markets are in retreat as investors look to unrest in China. We've all been watching these protests against strict COVID measures and lockdowns rage all over the country. So European shares have been falling from 3-month highs today, and the declines have been especially felt in the energy, retail, and mining sectors. In other news, we have more economic data coming out today in the Eurozone, this time about October household loans, while the European Central Bank President Christine Lagarde is testifying at the hearing before the Committee on Economic and Monetary Affairs in the European Parliament in Brussels today. So investors will definitely be looking for signals there too, especially in terms of what she thinks of the current rate hike policy and where the ECB is going to take it from here on to combat inflation. And that's what's happening here in Europe.
All right, thank you so much. That was Janelle Dumoulin there giving us the details from Berlin. All right, let's head on to other markets now. I was seeing Asia there. Shares in Asia Pacific are mixed after U.S. stocks rose overnight. New Zealand's central bank delivered a 75 basis point hike, the biggest rate hike ever in the central bank's history. And Singapore's latest inflation data showed some easing in October. on an annualized basis there. The NZX 50 index in New Zealand closed down about 0.85% at 11,323 points, while the S&P ASX 200 closed up 0.7%, despite the Reserve Bank of Australia Governor Philip Lowe on Tuesday hinting at more rate hikes ahead. South Korea's Kospi closed up about 0.53% there, and we see it right there, 2,408 points, while the ASX 200, that was down about 0.42% at 7,229 points. All right, let's head on to the UK. We have Juliana there standing by. Great to have you, Juliana. Let's look at some retail, the retail industry now. In the UK, we see Amazon's UK tax bill is proposed to could rise about £29 million amid business rates overhaul. Tell us more about this.
Yeah, good afternoon, Laddie. This is right. After much pressure from retail bosses in the UK who really suffered significantly during the first wave of COVID lockdowns, the British government decided to overhaul the pretty ancient business rates because, of course, bricks and mortar stores in the UK are not earning as much as online players such as Amazon. That's just one of them. So during the Chancellor's autumn budget, he did announce that there would be a revaluation of millions of industrial sites in the UK, and this is going to be backdated to April the 1st, 2022. And now most of the industrial sites in the UK are not owned by big online tech firms such as Amazon, Deliveroo and others. So there are some criticisms about this new shake-up because, of course, if you're just a small business operator who happens to have a big industrial site, you don't want your rent to go up. But I think they're now really trying to balance the difference between bricks and mortar and online stores, which is why they're bringing in this new tax to look at some of the sites you have. Again, it's not just Amazon. There are sites like Deliveroo, Gorillas, which is a very fast, swift online operator. They are able to have really big stores in central London, but not pay the ancient rates that have been paid. So some analytics sites have done some data snapping, and they've noticed that somebody like Amazon would be paying up to £25 million a year more in tax. Of course, Amazon are not happy about this. They've been long used as a case study by far gone business secretaries in the UK to say, look, we need to start cracking down on these big tech firms. Amazon is one of them, but with the renewed shake-up, they deem themselves to be unfairly targeted, particularly as they are one of the biggest private sector tax-paying firms in the UK. But things do have to change. We did just actually get some data from the British Retail Consortium looking at retail sales in the month of November. They have dipped yet again, even with the boost that we had on Friday from Black Friday. So high street stores are not doing well. And if you're not living in central London and you're living outside of the bubble, anybody who walks down a normal high street in the UK will see so many stores are closing, and it's because they just cannot afford to pay these rents. So they're hoping that this shake-up will make it more of an even balance. But like I said, Amazon not happy that they seem to be, taking the lot, or should we say the brunt, of this new tax system.
Yeah, I guess Black Friday couldn't save the day there. But the commodities heavy FTSE 100 saw it falling back about 0.8%. Looks like it's China zero COVID and protest fears. How's this impacting markets in the UK?
Yeah, it's pretty significant, actually, these unprecedented protests that we're seeing across China. Very, very rarely do we see any sort of civil unrest in the mainland. They have spilled over across the borders. There have been protests and demonstrations taking place at the Chinese embassy in London. I think the reason why it's caused so much anxiety, Laddie, is because, of course, anybody who is familiar with the kind of leadership skills of Xi Jinping, the Chinese president, knows that civil unrest is not going to lead to a relaxing of COVID restrictions. And I think so many global investors were hoping that these zero COVID policy measures would be lifted anytime soon. Lots of people really scared and fearful about what's going to happen. Apparently, some foreign journalists have also been arrested and detained for trying to record some of these scenes. It does affect big firms too. Burberry, a massive luxury retail store, they depend heavily on Chinese consumers. How is that going to impact them? We're not sure. Also, Apple have released a statement saying that they expect to release 6 million fewer iPhones over the coming months. So it's a significant story, one that the British government and, of course, global investors are going to be keeping a close eye on. Fears that this could spill into something bigger. As you said, oil majors are all trading down too. We also have that pretty bleak assessment from the British Retail Consortium looking at November retail sales figures in the UK. Is it likely going to be the same in December, where retailers on the brink are hoping to claw back some of those lost earnings? We think it will be. To have a quick look at the numbers, FTSE All Share, it's down by 0.52%, FTSE 100 down by 0.45%, and the FTSE 250, the domestic market, that's down by triple-digit figures, 1.31%. There is a little bit of hope in the currencies market. The British pound is trading pretty well against the US dollar. It's up 0.38%. I think one British pound will get you $1.20 at the moment, although the British pound is trading down on the euro by 0.79% and down to on the Japanese yen at intraday by 0.77%, Laddie.
All right, Julian, I guess it's all eyes on China at this point. Thank you so much.
Thank you.
All right, we'll take a break now. When we come back, more stories from the African continent. Do stay with us. This is Business Incorporated. All right, let's take the conversation to West Africa now. We're in line with Ghana's debt sustainability plan, which is working on in a bid to meet the requirements for loan from the International Monetary Fund. Ghana has said it will ask holders of its international bonds to accept losses of as much as 30% on the principal and forego some interest payments. Well, joining us now is Charlie Robertson, Chief Global Economist at Renaissance Capital. Great to have you on the program.
Thank you very much for inviting me.
So quite interesting times for most economies right now. What do you think will be the reaction from Ghana's international bondholders?
So far, it's fairly stable. They had priced in default, and they had turned much more negative on the bonds through the course of this year already. So it's assumed that there would be a restructuring, but they need more detail to be able to accurately say what the price of each bond's worth. Just knowing that there could be a cut in the principal up to 30% isn't enough to give us a proper figure on what the debt should be. But we're getting like 30, 40 cents on the dollar for most Ghanaian euro bonds now. So dollar worth of debt, you're only paying 30, 40 cents for it. So a lot's priced in.
Right, and many African countries seem to be having issues with, foreign exchange inflows. And we also see Ghana looking to buy oil with gold. What do you think?
Yeah. I mean, it's just it's another currency, and I would argue a lot more useful a currency than Bitcoin. So it's fair enough to be using gold. They could be using yuan, they could be using dollars, whatever. I think the challenge here comes from globally rising interest rates and the fact that the cost of borrowing has suddenly got very high for anybody who's got a low credit rating and hasn't got their own big savings pool. And too many countries in sub-Sahara, also Pakistan, don't have that local savings pool.
And with what's happening with Ghana right now, what's your outlook for the Ghanaian economy?
It's going to be really tough. I think it is already tough in per capita terms. With inflation up here, you would often expect a country to see negative per capita GDP growth. And the country was close, was really close to being able to take off in a kind of industrializing way. Human capital is really good. Adult literacy is around 80%. It's a thing I make a big deal about in the Time Traveling Economist book that I published a few months ago. They've got enough electricity to power manufacturing. But COVID hit, and at a time when COVID's there, people are not investing in new factories. They're not boosting exports. And Ghana, unfortunately, has then been hit by these rising global rates at a time when the debt burden was very high already.
Yeah, quite a tough time for the country. And obviously, we're seeing debt servicing in Africa is becoming, more of a headache with rising inflation, tightening cycle. What do you see coming for other, major economies in Africa? Take, for instance, Nigeria.
Well, Nigeria shares the same difficulty, the same challenge of very high fertility. And the time traveling economist points out that high fertility countries, firstly, are the most likely to default. And that's what happened in the 20th century with the Latin American debt crisis. Because people with huge families on average, big families on average, 5 to 6 kids, don't have savings to put into a bank at the end of the week. And because there's no money in the bank, banks don't have much money to lend. So if governments want to invest in infrastructure, in power, electricity, they borrow from abroad. And we've seen a whole host of countries from Egypt to Zambia to Ethiopia to Kenya to Nigeria do exactly that in recent years. Now, what we then saw in Latin America was that led to a debt crisis in the 20th century. And I think there is the risk of a debt crisis in a number of countries through the 2020s.
All right, I guess we'll keep tracking all these economies. Thank you so much. That was Charlie Robertson, Chief Economist, Renaissance Capital, the traveling economist. Thank you so much.
Thank you.
All right, that was Charlie Robertson there giving us the details from Ghana. Now, let's move on to other stories. Meanwhile, the Bank of Ghana has pegged the rate of depreciation of the cedi to the dollar at 54.2% in almost 11 months of 2022. Slower than the retail market, so Forex Bureau rate of about 14 cedis 90 to 1 American greenback. For the pound sterling, the country's currency has declined in value by about 48.9% since the beginning of the year. It's currently selling at 17 cedis 48. However, the central bank in its November 2022 summary of economic and financial data quoted the cedi to dollar at 13 cedi 10 to 1 US dollar. International research institution Fitch Solutions had indicated that the outlook of the Ghana cedi will depend on whether Ghana reaches an agreement with the International Monetary Fund and obtain funding in the months ahead. Also, total mobile money transactions in the first 10 months of 2022 grew by 12.9% year-on-year to 833.3 billion cedis, despite the implementation of the electronic transaction levy. And that's according to the latest summary of economic and financial data by the Bank of Ghana. In October 2021, total mobile transactions were estimated at 737.6 billion cedis, compared that figure to the same period in 2022. The transactions have shot up by an additional 95.7 billion cedis. A recent survey by the Center for Economic Finance and Inequality Studies revealed that many consumers do not pay e-levy despite undertaking mobile transactions. Traders say this because they have reached a gentleman's agreement with the vendors to enable them to deposit cash into the wallets of the receiver through a mobile money merchant account. And credit rating agency Fitch Ratings affirmed South Africa's credit rating at junk status with a stable outlook, saying the country's low growth potential was a key credit weakness. The ratings agency said the country's long-term foreign currency issuer default rating was constrained by the high and still rising government debts, low trend growth, high inequality, and the recent strike by public sector workers who are demanding a 10% wage increase, while the government is offering 3% and will continue to complicate fiscal consolidation. Fitch Ratings review comes after S&P Global also affirmed South Africa's ratings below sub-investment level, albeit with a positive outlook a couple of weeks ago. S&P also hiked its outlook on the country's state-owned power utility Eskom from negative to stable. And that's it on Business Incorporated today. Thank you so much for watching. I'm Ladi Williams. Bye for now.